Hare Krishna. Welcome to Tax Guru YouTube channel. This is C. Rohanar Pingale, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to the video series What Law Says. And today we are going to discuss two case laws under direct tax, that is income tax. So these two decisions considered herein were delivered in 2025 by two different high courts. One is Bombay High Court and one is Karnataka High Court. So both decisions involve significant issues under the Income Tax Act 1961 relating to procedural relief and characterization of receipt for tax purposes. So these rulings reflect ongoing judicial engagement with principles of fairness in procedure and characterization of receipts in the context of evolving commercial transactions. So let me allow to share my screen. Let's dive into it. So what law says? We will going to discuss two case laws today. So let's start with it. First case law, that is Balaji Landmarks LLP versus CBDT, Bombay High Court, and relevant assessment year is 2018-19. Date of order 14th October 2025, and relevant sections are sections 119, 139 and 153 of the Income Tax Act 1961. So let's understand facts of the case. The assessee Balaji Landmarks LLP filed its return of income for assessment year 2018-19 belatedly on 30th March 2019 beyond the due date of 31st October 2018 under section 139 subsection 1 read with section 139 subsection 3, but within the extended period under section 139 subsection 4. So the return declared a business loss, the carry forward of which was contingent on timely filing. The assessee applied to the CBDT under section 119 subsection 2 clause B, seeking what? Condonation of delay in filing the return, explaining that the delay occurred due to what? Time taken for obtaining the legal advice by its chartered accountant on a complex tax issue. So that CBDT refused the application, however, and which would lead to the loss of the right to carry forward the losses under section 72 and 80. Very interesting to understand it. So issue under consideration was whether the delay in filing the return should be condoned under section 119 subsection 2 clause B on the facts that the delay was attributable to what? Obtaining the professional advice, and whether the assessee should suffer result on hardship, that is loss of carry forward of loss, when it was not at his fault. So very, very interesting. Let's see what are the relevant legal provisions related to this case. Section 139 subsection 1 and subsection 3, that is time limit for filing return of income and consequences of belated filing. Section 139 subsection 4, that is extended period for filing return. Section 119 subsection 2 clause B, very important, that is condonation of delay in performance of any act required by the act if sufficient cause is shown. Section 80 relates with carry forward and set off of business losses, and section 153 1B, that is time limit for completion of assessment where return filed in belated period. So let's see what are the contention of assessee and revenue. Assessee contended that delay was bona fide, caused by reliance on professional advice in respect of complex issues, and denial of condonation would result in disproportionate hardship to the assessee and loss of carry forward of losses. So what was the revenue contention? Strict adherence to the statutory deadlines is necessary. Professional advice delay not a sufficient cause is what the revenue contended. Let's see now what are the High Court observations and it held. The Bombay High Court allowed the writ petition and condoned the delay in filing the return. So the bench emphasized that on assessee ought not to be prejudiced for delay arising from professional advice on uncertain complex tax issues. Clearly, High Court said that SEC should not be prejudiced for delay arising from what professional advice on uncertain complex tax issues, where the delay is not due to assessee's own negligence or malafide and causes genuine hardship to him. So, loss of right to carry forward of losses in given case, relief should be granted. So, the return filed on 30th March 2019 would be treated as written in accordance with the law and the assessment completed under section 153 1B. So let's see what principles laid down by this particular case. A taxpayer should not suffer disadvantage for bona fide delay attributable to the professional advice. So sufficient cause under section 119 subsection 2 clause B must be considered in light to substantive rights and hardship. So procedural relief can be granted where denial results in disproportionate hardship to the taxpayer. So these are the principles we can lay down. Now moving forward to today's second case, Manjeet Singh Chawla versus Deputy CIT TDS, Karnataka High Court. Relevant assessment year is 2024-25. Date of order 2nd June 2025. And relevant sections are Section 5, Section 17, Subsection 2, Section 45, Section 48, and Section 197 of the Income Tax Act 1961. So let's understand facts of the case. The petitioner was an Indian salaried employee of Flipkart Internet Private Limited, which is a part of a group of companies, including a Singapore parent entity. He received a one-time compensation for the surrender of stock options under a stock option scheme following a corporate event, that is divestment. So the petitioner applied under section 197 for a certificate of nil deduction of TDS, arguing the payment was not taxable income and therefore no TDS should be deducted. So, but revenue rejected the application, treating the payment as what perquisite under section 17 subsection 2 clause 6 and taxable, resulting in his writ petition. So let's understand what was the issue under consideration. Whether the one-time compensation for surrender of stock options constitutes taxable income, that is salary or perquisite requiring TDS, or is a capital receipt not taxable under the Act, and whether the rejection of the Section 197 application was sustainable or not. Very interesting. Let's understand what are the relevant legal provisions. Section 5, that is the scope of total income, what is includable in income. Section 17, subsection 2, clause 6, definition of perquisites in relation to employment. Section 45, that is chargeability under head capital gains. Section 48, method of computation of capital gains, that is the cost of acquisition. And Section 197, that is lower or nil deduction of tax certificates. Let's see what are the contentions of the assessee and then revenue. Assessee contended that the payment is a capital receipt in nature and not a perquisite. Cost of acquisition cannot be computed, hence not taxable under any head of the income. Application for nil TDS should be granted. And what revenue contended is that payment is linked to the employment and therefore taxable or requires TDS. What revenue contended? Payment is linked to the employment and therefore taxable or requires TDS. So let's see what High Court observed and held. Stock options not yet exercised and compensation for surrender is not perquisite under section 17 subsection 2 if not related to actual employment benefit at that stage, at that particular stage. So the payment is a capital receipt not chargeable under section 45 due to inability to compute what cost of acquisition and cannot be taxed under any other head since the charging and computation sections constitute what an integrated code. So REIT was maintainable and there was no adequate alternative remedy against the rejection of Section 197 application. So order rejecting the application for nil deduction was quashed and set aside, and the decision was declared in favor of the assessee. Let's see what principles laid down by this case. A receipt lacking the character as income and constituting a genuine capital receipt cannot be subjected to TDS. Section 197 certificate for nil deduction is sustainable. But why that constitute genuine capital receipt is very much important. How it is treated or why it is treated as capital receipt is very important. So head of the income classification must be determined based on characterization of the receipt and not on the manner of payment or deduction. Charging and computation provisions must be considered together. Inability to compute cost means capital gains cannot be charged. Let's see oral conclusions from both the two cases discussed today. Both the decisions underscores what the court's willingness to adopt the substantive justice over the procedural rigidity. In Balaji Landmarks LLP, procedural relief under Section 119 was extended to prevent what disproportionate hardship owing to reliance on professional advice. And in Manjeet Singh Chawla, careful analysis of characterizations of principles lead to the conclusion that a one-time compensation is a capital receipt, not taxable, reinforcing the importance of proper classification rather than mechanical tax deduction. So that's it for today. Thank you so much for patient hearing. Please note down my contact numbers. If you have any queries, observations, suggestions, then do let me know. Thank you. Thank you so much. Hope you are enjoying the video series and also getting the valuable knowledge from all these video series. So stay tuned to the Tax Guru YouTube channel. If you're not yet subscribed, then do subscribe it. Thank you. Thank you so much. Bye bye. Take care. See you soon. Hare Krishna.